Right at this very moment, somewhere in the Midwest, a retired nurse is signing a check to the IRS for a tax bill she never actually needed to pay. She did not break a single rule. She did not miscalculate her math. She is paying it simply because no one ever sat her down and explained that the tax rules she has followed for decades contain three very specific accounts. These are accounts with actual names, solid legal backing, and years of protection from Congress, where her wealth could be growing completely out of reach of any future tax bill. We are not talking about delaying taxes or getting a small discount. We are talking about wiping that money off the government's radar entirely. This is not some loophole. It is not a clever internet hack. This is the actual law, written plainly in the code, and waiting for any American who knows it is there. One of the sharpest financial minds of the last century spent a huge chunk of his career describing the IRS as an invisible partner in everything you own. When you make $1, your invisible partner demands a cut. When you invest and grow that dollar, your partner is waiting at the finish line with an open hand. When you leave that dollar to your kids, your partner chases it right to the grave. Most folks spend their whole retirement trying to bargain with this partner. They try to pay a little less here, move a little money there, and just pray the numbers hold up. But what this expert knew, and what almost no financial planner will ever take the time to tell you, is that the best strategy is not bargaining with that partner. The best strategy is buying him out completely. You need to move your money into a zone where he has absolutely no legal right to it. A place where the tax code itself, the exact same rule book he uses against you, plainly states he cannot lay a finger on your growth, your income, or the money you leave to your family. That is exactly what we are going to dive into right now. 3 accounts. Each one is already written into the tax code. Each one is completely legal. Each one is ready for you to use today. Put them together, and they create the biggest gap between what retirees usually pay in taxes and what the law actually requires them to pay. Here is our roadmap. First, we will look at a retirement account that lets your money multiply for 20 years and then comes out entirely tax-free, while secretly protecting your Social Security and Medicare from extra costs. Second, we will uncover the only account in the entire tax system that hands you 3 different layers of tax protection all at once, and we will see why most folks only use one of them. Finally, we will explore a tax bracket that is already sitting right there in federal law, year after year, allowing certain retirees to sell their winning investments and pay absolutely nothing in taxes on the profits. That nurse in the Midwest has no clue about these strategies yet, but by the time we finish, you will. Let us talk about the hidden tax trap and why so many retirees are handing over too much to the IRS without even realizing it. There is a specific kind of money pain that hurts far worse than simply making a bad investment. It is the pain of finding out, way too late, that you have been giving away cash you legally could have kept. Discovering that every spring for 10 years or more, you mailed a check to the government for an amount the law never forced you to pay. The rules were always there, completely legal and waiting, but no one bothered to tell you. This exact scenario is happening to millions of retired Americans right now. And the reason it keeps happening is not because people are lying to you. It is entirely about how the financial world is built. Think about the professionals who have guided your money over your lifetime. Your boss gave you a 401k and said to put in as much as possible. Your tax guy filed your paperwork and made sure the math was right. Your broker maybe picked out a couple of decent mutual funds for you. Every single one of those people did exactly what you paid them to do. But not one of them was paid to find a way to cut themselves out of your financial future. None of them had any real motivation to guide you toward an account that grows forever outside the grip of the IRS. The financial system rewards people for managing your money, not for setting it free. So, the accounts we are breaking down today remained hidden, not because they are hard to understand, and not because they are only for the super rich or the politically connected. They remained hidden because the entire financial industry makes its money on the wealth that stays trapped inside the traditional system. The money sitting in a normal brokerage account, getting hit with taxes on dividends every single year, the money pouring out of a normal IRA that shows up on your tax return as regular income. That is where the fees are born. That is where the management costs pile up. The second your wealth crosses over into a permanently tax-free zone, it becomes far less profitable for the people who make a living taking a percentage of it. Let us look at the actual math here, because these numbers are very real. Imagine you retire at 65 with $500,000 sitting in a traditional 401k or a traditional IRA. This is a very normal situation for a lot of Americans. You start pulling out $40,000 a year to pay your bills. The IRS looks at every single dollar of that withdrawal as regular taxable income, let us say at a 22% federal rate. That is $8,800 a year going straight to federal taxes, and that is before your state even takes its cut. Over a 20-year retirement, you are sending $176,000 to the government. This is money you already worked for, money you already saved, and money you were supposed to be enjoying in peace. Hearing that number usually stops people in their tracks, and it should, because it is not just a massive tax bill, it is a massive failure to understand what the rules actually allow. The three accounts we are talking about today do not just trim that number down. They do not just push the tax bill down the road to another year. They change the game at a much deeper level. They change which of your dollars the IRS is legally allowed to look at in the first place. This is completely different from claiming a tax credit or a deduction. A deduction just shrinks the number the government taxes. The strategies we are talking about today erase the money from the conversation entirely, long before any math is even done. There is a bigger picture here you need to grasp before we move on. The IRS does not mail you a postcard when a new tax benefit fits your life. The tax code does not have an alert system. There is no government hotline where an agent calls up retirees and says, "Hey, here is a trick that has been around for 20 years that will save you $100,000 over your retirement." The whole system is built on the hope that you will stumble onto these rules yourself, or that someone you know will point them out. For most people, that day never comes. The accounts we are diving into have been parked in the tax code for a very long time. The Roth IRA was born in 1998. The health savings account was written into law in 2003. The 0% capital gains bracket has been hiding in plain sight, right there in Section 1, Paragraph H, surviving president after president. The IRS quietly updates its income limits every single year. These are not unproven ideas hoping to get passed by Congress. They are the law of the land right now. The only thing blocking most retirees from keeping this money is simply knowing these rules exist and getting a clear, plain English breakdown of how to use them to build a retirement income. Let us look at account number 1, the Roth IRA. This is how you take your retirement nest egg completely off the table for the IRS, forever. Most folks who have heard the term Roth IRA think they get how it works. They know it is different from a regular IRA in some fuzzy way, and that it has something to do with taxes. But what they miss, and what makes the exact difference between a stress-free retirement and a decade of wasting money on tax bills, is how uniquely this account acts when you actually start spending the money, and how many different headaches it quietly cures at the same time. Let us build this from the ground up so it makes perfect sense. When you throw money into a traditional 401k or a regular IRA, you are signing a deal with the government. That deal says, save your money now before we tax it, let it grow, and we will square up later. Well, later turns out to mean every single time you take $1 out in retirement. Every penny that leaves a traditional account gets hit as regular income tax in the year you pull it out. The IRS stayed quiet when you put the money in, but they become incredibly loud when you try to take it out. A Roth IRA completely flips that script. You put in money that has already been taxed. The government takes its bite at the very beginning. From that moment on, every bit of growth, every profit, every dividend, And all that compounding interest over 10, 20, or 30 years belongs entirely to you. When you pull money out of a Roth IRA during retirement, the IRS gets absolutely nothing. They cannot tax your original money, they cannot tax the growth, and they cannot touch what could easily become hundreds of thousands of dollars by the time you retire. To see the actual math, imagine this. If you put $7,000 a year into a Roth IRA starting at age 45, and you invest it in a simple, low-cost index fund that grows at an average of 7% a year, that account will climb to roughly $340,000 by the time you turn 70. Every single dollar of that $340,000 comes out completely tax-free. Your $63,000 in total contributions are safe. The $277,000 in pure investment growth is completely untouched. The IRS, which would have taken a massive chunk of that cash if it were in a traditional account, gets zero. But this is where most people stop thinking about the Roth, and stopping here is a massive mistake. Tax-free withdrawals are just the very first layer of what this account does for you. The second layer involves your Social Security check, which is a trap the vast majority of retirees fall into far too late. Most folks think their Social Security check is either taxed or it is not. In reality, it depends entirely on what the IRS calls your combined income. This is a special math equation where they add up your adjusted gross income, any tax-exempt interest, and half of your Social Security benefits. If that total number goes over $34,000 for a single person, or $44,000 for a married couple, the government can tax up to 85% of your Social Security check. When you pull money from a traditional IRA or 401k, every single dollar pushes that combined income number higher, dragging more of your Social Security into the tax trap. But when you pull those same dollars from a Roth IRA, it is completely invisible. It does not count toward that calculation at all. As far as Social Security taxes go, that withdrawal does not even exist. The third layer has to do with your Medicare premiums, and this one catches people completely off guard. Medicare does not charge every single retiree the same monthly price. They look back at your income from 2 years ago to decide what you will pay for your health coverage. If your income passes certain lines, they slap you with an extra surcharge that pumps up your Medicare bill significantly, and that extra fee stays stuck to you as long as your income stays above that line. For a single person, that extra charge can trigger surprisingly early. A retiree pulling heavily from a traditional IRA can cross that line without even realizing it, and end up facing higher healthcare premiums for the entire next year. The exact same retiree using a Roth instead keeps that income completely off the radar. It never shows up, it never counts, and it never triggers the extra fee. Now, there is one more detail about the Roth IRA that most guides leave out, and it is incredibly important if you have always assumed you make too much money to qualify. There is a limit on how much you can put in, and there is an income ceiling where regular contributions are blocked. This limit starts around $150,000 for single people and roughly $236,000 for married couples. Above those lines, the front door to a Roth IRA snaps shut, but the back door stays wide open. There is a completely legal, IRS-approved strategy called the backdoor Roth conversion. It has been perfectly legal for over 15 years, and Congress has looked at it multiple times and chosen to keep it in place. The steps are simple. You open a traditional IRA, put in money you have already paid taxes on, and choose not to take a tax deduction for it. Then, you immediately move that money over into a Roth IRA. If you do this quickly, there is no tax on the transfer because the money has not had time to grow yet. Your clean, after-tax money lands safely inside the Roth. From that second forward, it grows exactly the way we discussed, forever safe from federal income taxes, completely hidden from your Social Security math, and totally absent from your Medicare premium calculations. Let us move on to account number 2, the health savings account. This is the only asset in the whole U.S. tax system that is completely triple tax-free. If someone told you there was a single place where your cash goes in tax-free, multiplies for decades without the government taking a single cut of the profits, and comes back out without counting as a single penny of income, you would probably think it is some hyper-complex strategy. You would think it is a tool built only for massive companies or ultra-wealthy executives with a small army of lawyers on the payroll. You definitely would not think it is an account that an ordinary school teacher, a delivery driver, or a local nurse could set up by tomorrow afternoon just by picking the right health insurance option. Yet, that is precisely what a health savings account does. The massive disconnect between what most folks think this account is for and how it actually functions when handled correctly is one of the costliest errors in personal finance. Most people who own one of these accounts use it exactly how their HR department explained it during benefits week. Money goes in from their paycheck, a doctor bill shows up, they spend the money, and the balance stays flat. They use it like a temporary parking spot for prescriptions and copays, so it never has a chance to build into real wealth. Doing that only unlocks one of the three massive tax perks this account holds. It leaves the other two advantages completely abandoned on the table for years, or even an entire working life. Let us break down these three layers one by one, because you need to see how they work individually before you can understand the sheer power they have when combined. Layer number one is when you put the money in. Every dollar you feed into a health savings account drops your federal income tax bill. But if you do it directly through your workplace payroll, it saves you even more. It bypasses federal income tax, skips state income tax in almost every state, and avoids the Social Security and Medicare payroll taxes that automatically drain another 7.65% from your hard-earned cash. Depending on your specific tax bracket and where you live, that means you instantly keep 20 to 40 cents of every single dollar you save simply because of the account you chose to put it in. Layer number two is how the money multiplies. The cash sitting inside this account does not have to just sit there earning pennies in a basic savings vehicle. You can actually invest it. You can put it into broad stock market index funds, the exact same long-term wealth builders you would use in any standard retirement account. And every single dollar of growth inside that account compounds year after year without the IRS snatching a piece of the pie. No yearly taxes on your dividends, and no capital gains taxes when you buy or sell positions. The account just grows freely, completely unbothered by the IRS. Layer number three is when you take the money out. And this is what makes this account stand completely alone. When you pull money out to cover a health expense, it is not treated as income. It never shows up on a tax form. It does not inflate your combined income numbers. It has zero impact on your Social Security taxation, and it never triggers a Medicare surcharge. To the IRS, that money is entirely invisible. A standard 401k hands you the first two layers, but hits you with taxes on the way out. A Roth IRA gives you layers 2 and 3, but you have to use money that has already been taxed to get in. The health savings account is the absolute only vehicle in existence that gives you all three layers at the exact same time. That is why it holds a title no other account can touch, the ultimate triple tax advantage tool. To start using one, your healthcare plan has to be classified as a high-deductible health plan. For the year 2026, that means your plan must have a minimum deductible of roughly $1,650 for an individual or $3,300 for a family. If your coverage fits that description, you can jump right in. The 2026 rules allow you to put in up to about $4,400 for individual plans and $8,750 for family plans. Plus, if you are 55 or older, you can tack on an extra $1,000 catch-up contribution. Now, here is the exact secret that transforms this from a basic medical fund into one of the absolute strongest retirement assets you can find. It all comes down to a single rule that almost nobody ever hears about. The IRS has absolutely no deadline on when you have to pay yourself back for a medical bill. None at all. If you pay a $400 doctor bill out of your own pocket today and save the receipt, you can cash in that receipt for a tax-free payout from your account 5 years from now, 15 years from now, or even right before your 80th birthday. The only rule from the IRS is that the medical bill had to happen after you opened the account. The clock on collecting your cash never stops ticking. In the real world, this means if you pay your medical bills out of pocket today and leave the money inside your account untouched, you are pulling off a brilliant double move. First, you are letting your invested balance snowball completely tax-free. Second, you are quietly building up a mountain of receipts that act as a tax-free cash vault you can open whenever you want during retirement without triggering a single penny of income tax. A retiree who diligently tracks their healthcare receipts for 20 years can step into retirement with a massive six-figure account balance backed up by thousands of dollars in old receipts. That means tens of thousands of dollars in pure tax-free cash that the IRS can never treat as income, can never use to jack up their Medicare premiums, and can never use to tax their Social Security benefits. Now let us look at account option number 3, the 0% capital gains bracket. This is a tax rate sitting in the U.S. law books that most working citizens never run into. It is not because it is hidden away in some top-secret folder that only elite tax lawyers can read. It is simply because the conditions required to qualify for it rarely show up while you are still working a regular job. It sits there year after year, written clearly into federal law. The IRS quietly tweaks the numbers every January, waiting for the exact scenario that retirement automatically creates for millions of everyday Americans. Yet, the vast majority of retirees walk right past it. Not because they do not qualify, but because nobody ever told them it was an option. That rate is exactly 0. A true, legal, government-approved 0% tax on your investment profits. Not delayed, not reduced, and not kicked down the road. Just straight up 0. Knowing how this works, and recognizing the short window of opportunity at the start of retirement before it shuts, is what separates a retirement built on real tax strategy from one built on pure guesswork. Here is how the foundation works. When you sell an investment that you have owned for over a year, like a stock, an index fund, an ETF, or a mutual fund inside a regular taxable brokerage account, the profit you make is called a long-term capital gain. Most folks are pretty familiar with the 15% tax rate that hits the middle income brackets. What they do not realize is that right below that 15% line, there is another tier entirely. If your total taxable income, after you take out your standard deduction, falls at or below $49,450 as a single person, or $98,900 as a married couple filing together in 2026, your long-term capital gains tax rate drops to 0%. The IRS has every right to take a piece of those profits, but under this rule, they choose to take nothing at all. Now, think about who normally lands inside that income bracket. Generally speaking, it is not people who are in the middle of their peak working years. A household that has managed to build up serious investments over a lifetime usually makes far more than those limits while they are employed. But retirement completely reshapes your income picture. The regular paychecks stop. The standard salary vanishes from your tax forms. In those early years of retirement, specifically that quiet window after you stop working, but before your Social Security checks and your required minimum distributions start filling your income bucket back up, your taxable income can drop massively. It often plummets way below a ceiling that felt completely out of reach just a few years before. That specific gap, that brief window of low income in the opening stage of retirement, is exactly where the 0% bracket becomes an absolute goldmine. Because sitting inside the regular taxable accounts of many retirees is wealth that has been quietly compounding for decades. These are stocks bought years ago at prices that look incredibly small compared to what they are worth today. Index funds picked up in one decade and held patiently through years of market ups and downs. Every single one of those investments carries what the industry calls a built-in gain. That is just the gap between what you paid for it back then and what it is worth right now. That profit has been waiting for the exact moment you lock it in by selling. If you sell during a high-income working year, you are handing 15 or 20% of that gain right over to the government. But if you sell in a low-income retirement year, beneath that 0% ceiling, capturing that exact same profit costs you absolutely nothing. The asset did not change. The profit did not change. The only thing that changed was the income situation surrounding the sale, which is something a smart retiree can completely control. But here is the twist that elevates this strategy from a simple one-time trick into an ongoing system you can use year after year. It is the exact part that almost everyone misses when they first discover the 0% bracket. When you sell a winning investment to lock in your profits at 0%, you are not forced to walk away from that investment. When you lose money, the tax laws use something called the wash sale rule, which stops you from selling a bad investment for a loss and immediately buying it back just to claim a tax break. But that restriction applies strictly to investment losses. It does not touch investment gains. You can sell your winning investment, lock in every single dollar of that growth at a 0% federal tax rate, and buy back the exact same fund the very next morning without breaking a single rule. The reason this is such a massive deal comes down to your cost basis. Your cost basis is simply the original price you paid for an investment, and it is the baseline number the IRS uses to calculate your taxable profit when you eventually sell for good. By selling your fund and instantly buying it back, you reset that baseline to today's higher price. All that investment growth that just passed through your hands at a 0% tax rate is now locked in at the new, higher value. The next time you sell that asset to spend the money, your taxable profit starts counting from that new higher floor instead of the tiny original price you paid years or decades ago. You have basically wiped out years of built-up tax debt without spending a single penny to do it. You can repeat this exact process during every single low-income year of your retirement, bumping your baseline higher bit by bit and shrinking your future tax bills down to nothing. Let us connect all three pieces into a single retirement blueprint that keeps the government's hands out of your pockets for good. Most conversations about retirement are completely fixated on building up the pile. How much cash do you need to save? Which funds should you buy? What kind of returns are you chasing over 30 years? While those questions matter, they only answer half the riddle. The half that rarely gets discussed but costs people the most money over a real retirement is deciding which of those dollars the IRS actually has the legal right to touch when you start spending what you built. The size of your nest egg and the actual amount of spending money you take home are two completely different things, and the gap between them comes down to choices most people never even realize they are making. The three strategies we just covered share one exact goal. Each one, in its own distinct way, blocks the IRS from counting your wealth as taxable income. The Roth IRA shields your investment growth forever. The health savings account completely covers your medical bills. And the 0% capital gains bracket wipes away taxes on your stock profits during the years your income drops below the ceiling. Used on their own, each one saves you serious money. But when you orchestrate them together with a clear plan, the kind of smart strategy most retirees miss because no one maps it out for them, they create a bulletproof, tax-free income stream. It builds a retirement where the government's footprint on your financial life shrinks to almost nothing. Let us look at how this plays out in real life. Imagine a married couple, both 66, who just wrapped up their careers. They take home $36,000 a year from Social Security. They have a Roth IRA they have been building for 15 years, now sitting at $280,000. They have a health savings account worth $190,000 invested in the market, along with a folder stuffed with $22,000 in medical receipts they saved over the years. Finally, they have a standard brokerage account holding index funds with about $80,000 of built-in capital gains from decades of investing. In a typical retirement, without knowing these rules, every single dollar they spend past their Social Security check would come from a fully taxable account. Each withdrawal would push their income higher, dragging more of their Social Security check into the tax trap, potentially triggering a massive spike in their Medicare premiums and draining their brokerage accounts while losing 15% to capital gains taxes year after year. Over 20 years, that standard approach would easily cost them well into six figures in pure waste. But with a coordinated strategy, the entire landscape shifts. Their Roth IRA payouts generate zero taxable income. Every dollar they take from it is completely invisible to the Social Security tax math, hidden from the Medicare premium formulas, and totally absent from their tax forms. Their health savings account pays for medical costs that would normally force them to pull taxable cash from other places, meaning their healthcare spending never adds a dime to their tax bill. And during the years their regular income stays safely below the 0% threshold, they sell off those winning investments in their brokerage account, lock in the gains at zero tax, and instantly buy them back to raise their cost basis, systematically erasing their tax debt without handing a single dollar to the IRS. The final result is a retirement income stream that sits almost entirely outside the reach of federal income taxes. This is not because of high-risk setups, shady maneuvers, or temporary loopholes. It works because every single one of these accounts is woven into existing federal law, has survived decades of political shifts, and does exactly what the rulebook says it does when you understand all three layers instead of just reading the cover. There is just one final piece to this strategy that you must watch closely because it can either supercharge your savings or accidentally trip you up. All three of these accounts hit the exact same calculations. While Roth payouts protect your Social Security and keep your Medicare bills low, trying to lock in too many capital gains in the exact same year you pull from a traditional retirement account could push you right over that 0% ceiling. That mistake would ruin your tax-free gains and trigger the exact Medicare fees the Roth was supposed to block. These tools work best when you view your income as one connected picture, rather than making separate choices in a vacuum. Every autumn, before the year wraps up, the smartest move you can make is to map out your total taxable income. Find out exactly how much breathing room you have left under those tax lines, and time your withdrawals perfectly so that every single dollar you spend carries the absolute lowest tax possible.